India's economy has just delivered a surprise in 8.2% GDP growth in the second quarter of the financial year. This is India's fastest growth in 6 quarters, beating all projections by economists, rating agencies, and even the Reserve Bank of India itself. So the big question is, how did India beat expectations? And what does this mean for India's long-term economic ambitions, from becoming a multi-trillion-dollar economy to emerging as a global growth engine? Let's break it down clearly, comprehensively, and with global context. India recorded 8.2% year-on-year GDP growth, far above the projected 6.6% to 7%. Economists worldwide were surprised because this kind of fast growth usually requires strong domestic demand, strong exports, and strong investment all at the same time. India saw three major pushes. 1. Private consumption jumped sharply. Urban and semi-urban households spent more on goods, services, travel and retail. Consumption makes up nearly 57% of India's GDP, and this rise alone boosted the growth numbers significantly. 1. Manufacturing and construction delivered exceptional performance. Manufacturing grew more than 9% while construction stayed strong. This hints at improving capacity utilization, more factory output, and rising demand for housing and infrastructure. 1. Inflation dropped sharply, boosting real GDP. This is important. When prices rise slowly, real GDP mathematically increases. This GDP deflator effect added an unexpected mechanical lift to the growth number. These three factors, demand, production, and low prices, combined to push India above expectations. Predictions were lower because exports had recently slowed down, global trade tensions were rising, oil prices were uncertain, and consumer confidence earlier in the year was weak. But several things changed quickly. Banks improved lending conditions, corporate investment revived in key sectors, government capital expenditure accelerated, some export orders were front-loaded due to global uncertainty, labor participation improved, supporting services and local demand. In short, India's economic fundamentals strengthened faster than anticipated. This growth offers several near-term benefits. 1. Boost investor confidence. Foreign and domestic investors see India as a high-growth, low-inflation environment. 1. Strengthens India's fiscal position. High GDP means better tax revenues later, giving the government room for public investment. 1. Creates momentum for job creation. Manufacturing and construction growth usually mean more employment opportunities. 1. Gives RBI flexibility. With inflation low, the central bank has room to maintain accommodative monetary policy. Overall, India enters 2026 as one of the fastest growing major economies in the world. India has set ambitious long-term targets. Becoming a $5 trillion economy, strengthening domestic manufacturing, becoming a global export hub, creating millions of high-quality jobs, competing with global economies like China, Japan and Germany. Now the real question. Does the 8.2% growth number bring India closer to these ambitions? The answer is yes, but with important conditions. Here's what this growth means for the long run. 1. India can maintain 7-8% growth if it fixes bottlenecks. Productivity, infrastructure and skills training will be critical. 1. Manufacturing-led growth is finally showing momentum. If this continues, India can build strong global supply chains in electronics, semiconductors, defense production, pharmaceuticals, renewable energy. 1. India needs strong nominal GDP growth. Low inflation boosts real GDP, but if nominal growth stays low, government revenues suffer. That's something policymakers must watch. 1. India must protect itself from global shocks. Trade tensions, oil prices, and geopolitical risk can slow exports. Diversification will be key. It's important to understand that not all of this 8.2% growth is permanent. Some parts may fade, the deflator effect, low inflation can reverse, export slowdown may worsen, global recession risks remain, government capex alone cannot sustain high growth forever. So the message is clear, India has strong momentum, but sustaining it requires deeper reforms and consistent investment. India's 8.2% GDP growth is more than just a number. It is a signal, a message to the world that the Indian economy is entering a phase of high growth, stability, and global relevance. But long-term success depends on strong manufacturing, high employment, innovation and technology, global competitiveness, consistent reforms. If India maintains this path, it may not just meet its economic ambitions, it may exceed them. Thank you for watching. If you found this analysis useful, do like the video, subscribe to Knowledge Suitcase and tell me in the comments, do you think India can sustain 8% growth for the next decade? See you in the next video.